A very good evening and welcome to today's special back-to-back session on Hong Kong warrants, China markets, and everything in between. So today we've got a very special back-to-back week for you, where we're going to have Tuesday, that is today, with Mr. Johanne Lee, the Chief Investment Officer of Honghu Capital Management from Hong Kong, and our guest speaker on Thursday, Mr. Kevin Liu, Managing Director of CICC Research China. So I just want to give you a bit of a recap before we start. So I know it's been quite a quiet week in the Hong Kong markets and the Malaysian markets. The Hang Seng has been showing some consolidation over the 20,000 range and above. And the Malaysian markets, we've all been looking just honestly at rubber gloves, and that's about it, isn't it? And maybe the small caps and the penny stocks. But life is already hard. But life is even harder if you're stupid. So I would like to say that this is the perfect time for you to join us today, get your knowledge, get insights, and prepare for the markets ahead, right? You want to be prepared before the opportunity comes, not caught unaware when the market starts to rally and you don't know what to do, what products, and you have no background on what you should be trading on or taking advantage of. So without further ado, I would like to introduce to you Mr. Johanne Lee. Hi, Johanne.
Hi, Isabelle.
Thank you for joining us all the way from Hong Kong. As you know, Mr. Johanne Lee, he's the Chief Investment Officer at Honghu Capital Management. And thank you so much for joining us here this Tuesday evening. Don't be fooled by Mr. Johanne Lee's cool demeanor and calm attitude. He's incredibly knowledgeable, insightful, and I hope you enjoy the session. Over to you, Mr. Johanne.
Thank you, Isabelle, and thank you, Kenanga, for the invitation. I'm a great pleasure to present for your clients. Right now, I'm going to share the slide that I've been prepared. I just want to have a brief performance review for the Hang Seng Index in Q1. The Hang Seng Index was trading in 19,570 in the beginning of the Q1, and then at the end of Q1 it was 20,400, and it's rallied 830 points, and it's almost 4.24%. And the highest point is 22,700. It was on January 27th. And the lowest point was 18,290. Is on March 20th. And it was 4,400 points swing from the top to the bottom for Q1. The Hang Seng Tech Index also doing quite well in Q1. It went up to 5.42%. I just want to show you guys some charts that I've prepared. First, I'm going to show you the Hang Seng Index right now. I've drawn some trend line on it, and I think the Hang Seng Index will still trading in a range like last time, but the range will be a little bit different in Q2. I think it was trading between 19,000 to 21,500, and this is how it looks like. Well, you could see the index should have trading within this range. As I said, above 900,000, and we may very soon test the 21,500 range. And after that, if it's successfully go through this level, I think it may testing the this year high, which is 22,500 range. But I don't think it will be that easy. Very likely, I think the index will be swinging from 21,000 and 20,000 for few more weeks. And you see, ever since the last March, the index is already breaking the downtrend from February to March. So actually, I think the very likely, I think, for the first half, Hang Seng Index already sees lows, and hopefully within this 1-2 months, it will be a upward trading range. And then I think the support will be recent short-term support should be the 20,000 level. And also for the Hang Seng Tech Index, it's even more obvious. The trading range is very narrow recently for more than 2 months. For more than 2 months now, and then it's create a huge triangle daily, and I think it will breaking up soon. So hopefully, I think the index should go up, like because of multiple reasons. Such as the government start to giving tech company more room for growth, and then just recently there's rumor saying that the government will not fine Alibaba for a huge fine. They are going to give them a brief. So I think very likely the Hang Seng Tech Index will trading between 4,080s as a support, and then may test 4,270 during the Q2. And you could see it's a very tight trading range at this moment. And if it gets successfully breakout, I think the index will test 4,500 points. Here is some sector performance during the last 3 months. I would like to point out there are some interesting finding here. For many months, telecom company has been outperformed the market for so long, but these things has changed. As you could see, for 3 months end, telecom, internet, and software are still the top performer in Hang Seng Index. But for recent months, they have been replaced by insurance and automaker, which is the underperformer for almost a year now. There's multiple reasons for that. I will we'll point out some reasons for this happening. And you could see gold, precious, and metals is always been strong through the last 3 months or last 1 month. It's been outperforming the market, and then it's going up 22%. And you could see the gold price also is going up, and most of the basic material has been rebound from the lows in recent months too. But the real outperformer are the golds and precious metal sectors. And I would like to share some key events from the U.S. and China trading war on technology. Ever since 2018, it's been quite intense that the U.S. keep putting restriction on Chinese import of technology, and also it's restricts some of the Chinese company to list in the U.S. and doing business in U.S. They have created a huge list of sections. Right now, there's some things changing. In the past, Beijing has just held back on all kinds of U.S. restriction on sales of design software and semiconductor manufacturing equipment. It's just kept silence. These companies include NVIDIA, AMD, and then the U.S. is just restricts those companies to sell their high-end products to Chinese firms. But on March 31st, China announced a security review of U.S. memory chip giant Micron Technology. This company is one of the biggest chip maker in the US, even in the world. After they recently acquired another chip maker. So Chinese government's trying to do some review on the company, is actually signaling a revenge on the U.S. trade war sanctions. This company is quite important to both the Chinese and Chinese company and also the U.S. company, because this company, the Micron Technology, is doing business in China, and then most of the revenue, like 16% of the revenue, is coming from China and Hong Kong clients. So that the rumor came out, and then China may restrict. Also, another rumors came out. China may restrict export of rare earth metals. By the surface, rare earth is just like another product, not related to technology, but actually it is, because most of the semiconductor need rare earth to build as a building material. And China has processed almost 90% of rare earths in the world. So if it's come true, it will be a very big hit to the U.S. technology company. And in a way, maybe Chinese governments would like the tech company, U.S. tech company, to reconsider doing business inside China if they trying to ban exporting the rare earth. So this is actually the way to attract investment from the U.S. if this comes true. And then another reason, I think, why the U.S. and why the China government has changed their mind and start doing something on that trade war revenge, I think is you could see on this graph, ever since 2018, the net export from China to U.S. has been declining, but recently, after 2001, the amount has been rebounding, and I think and it's almost recover and making a new high. That means the decoupling is actually not that severe, and I think the Chinese government think that they have more chips on the table, so they want to do something to fight back, and which could affect the market. And I would like to share another key events that's happening in the economy right now. Ever since 2 to 3 years ago, the government has announced policy that the real estate should not as a speculative vehicle and should be used as a residential only investment. And ever since they have imposed a lot of restriction on Chinese real estate developer lending, and it's make the home price going down significantly, and the home selling market has almost dropped 80% in the past year. I mean the transaction. But right now there's some sign of recovery. The recently announced report from NBS saying that the 70 biggest cities' new home prices increased another 0.4% month to month in March. It's actually the second increase month over month in the row, with broad-based gains across all kinds of cities, big and middle one. Compared to the previous months, new home sales price declined in 5 cities only in March versus 13 cities in February. Increase in 64 cities versus in 55 cities in February. The strong credit report also signaled in Q1 that improving developers financing and home buyers sentiments. So it's actually, you could see these recovering in the housing market could benefit the bank. Buyer is still very cautious on picking a reliable developer though, and less reluctant to buy flats in the it's more desire to buy flats in the second-hand market in order to avoid the possibility of incomplete transition from builder. I've been talked to some mainland visitor from China to Hong Kong. There's a finding that there's a young age group, they are still very reluctant to buying the house because they think housing is not going up, and they could have a lot of time to save their money to get a nice flat, and in the meantime they will just happily rent a flat. So I think disregard the news that the home price is improving. I think Chinese real estate developer is still a not very good investment at this moment because the real demand is not coming back. But the news is actually signal a very healthy recovery for those real estate developer, at least. I think this recovering of housing market is actually benefiting the Chinese bank and the insurance company, because like Ping insurance company before they was hard hit for more than 2 years, because they have heavily invest and lent a lot of money to those Chinese real estate developer. And now if there's sign of recovery of the sector, I think the insurance company will have greater rating by investor later on. And also for the Chinese bank, because they are also heavily lended to those real estate developer and also home buyers. So I think the recovery housing market will give a Chinese bank a very good sentiment. And there are some news coming up, some also finding from the Chinese bank. The total assets of the banks and other financial institutions rose 10% year over year, to 382 trillion RMB at the end of February 2023, and this is accelerating from a growth of 10.2 at the end of December. And it shows continuous improvement by the total assets. With the large banks and city commercial, they are lending more. They could lend more to the public. And then also, the street has seen the bank has a higher than required provision coverage ratio. That means they have more room to lend out their money and more room for the profit. And also, just last month, the Chinese government just lowered the IRR for the third time. It's also gives the bank more flexibility to lend out more money. And then also, the figure shows that bank assets quality will remain stable and suggests what the non-performing loans should be lower. That means it should be supported by a healthier real estate market and better retail condition in the public. and that will drive the bank revenue higher. And then the bank should have more profitable and more stable core tier 1 capital adequacy ratio. So actually, for this Q1, after the Q1, there's a lot of good news for the bank and insurance company. I think they are doing quite well too. And I would like to also to share some interesting charts with you guys. It's a US dollar index. As you could see, I just used the US dollar ETF to show the direction of the US dollar. It's quite important for emerging market because ever since every time if there's a strong uptrend for the US dollar, emerging market like China and Hong Kong market will be under pressure greatly. So you could see from 2022 to February to September 2022, you see there's a very nice uptrend, and that's the actually response. The Hong Kong market and China market has responded with a great collapse in price, and then in the late 2022, approaching October when the US dollar peak, coincidentally the XSI had hit the 40,000 level and starting to rebound. Right now, you could see that the index has a nice rebound and then could not escape the Great Triangle now, and then is pointing down again, and which I think will benefit the equity market in China and Hong Kong for a while. If for the rest of the year, if US dollar keep going down, I think the Hong Kong market should do well. And another interesting chart I would like to share with you guys is the high yield corporate bonds. It is actually very rate sensitive because ever since FOMC raised the interest rate rapidly, you could see the high yield corporate bond has collapsed in value from the beginning of 2022, and then it's hit the bottom coincidentally at October, like the reflected by the US dollar index, is actually forming a bottom. I would like to think that if FOMC starts to lower the interest rate, the high yield corporate bonds should do very well in the later of the year, which is quite interesting because usually bond and equity do not go with the same direction. But in this case, because it's a high yield corporate bond, I think this will go with equity market too. And another chart I would like to share is the commodity index. If you could say, I would use the Bloomberg one, and it's another ETF to show that it's been a downtrend ever since 2022, but it has sign of rebounding from the bottom. I think if this breaking the trend and then keep going up, it may signal that the fear of recession in the US or globally, the risk is lower if investors driving the commodity index up. So I think it's actually a good sign to take a look. If the US dollar going down, this commodity index going up, and also the high yield corporate bonds is going up, then I think the equity market should continues to do well. Well, and this is another chart that shows the Federal Reserve balance sheets. As you can see, it was declining from the peak during 2022, but ever since those incidents for the signature banks and the Silicon Valley Bank collapse, Federal Reserve actually pumping money into the market secretly, so that, like people say, this is stealth easing, and it's just in 1 week, the balance sheet of the Federal Reserve has been expanded to $300 billion, and you could see that there is a huge rebound by the end of the March. And that's why I would like to talk about the U.S. inflation and the economy too, because it has a great effect on the interest rate, and then it will in return affect emerging market a lot, because it will dictate the money flow from emerging market to developed market. I would like to show you guys some study on this topic. Firstly, right now the inflation, we call it sticky inflation, because the main driver of this inflation is wages and housing. Energy is not as big part as before. So even though the oil has been stable between $60 and $70, the inflation has come down very slow. The high wages induce firms to raise price, which is in return pumps consumers to demand higher wages in the future. This cycle has make the inflation harder to come down, and also it will drive up the rents. That's why the inflation in the U.S. has not dropping as fast as people think, or even though there's sign that the pace of growth has been slowing already. But if the inflation has to go back to the FOMC targets of under 4%, I think it will take much longer, because both components of the wages and housing is not easy to change the trend. So in the past, in the 1970s, there's time the inflation has gone up significantly in very short period of time, and I find there's a three different period. The U.S. company experienced 3 waves of inflation and has 4 recessions in the past. The first waves is 1967 and 1970. The CPI rose from 2% to about 6%. From 1970 to 1971, it fell from 6% to 2%. It was quite volatile at that time. And the second wave, the CPI rose from 2% to a whopping 12% within 2 years. We have not experienced that this time. The peak is like 8-some% to 9%. The third wave pushed the CPI from 5% to 15% within 3 years. In all, it took more than a decade to bring down inflation. In the first wave, the Dow actually rose from 383 in June 1970 to 1,020 in December 1972, during a period of deflationary. During the second wave of inflation, it fell from 1,020 points on December 1972 to 607 September 1974. And sticking together, investor can invest in stocks during the inflation times when in interest rate are fall. Of course, there's no guarantee that the history will repeat itself. But in June 2022, market low coincidentally with the CPI peak. So I would say that the CPI would have very great effect on the interest rate direction, and investors should watch closely on US CPI condition. And the current policy of quantitative easing could be another stimulus that can boost the stock market when interest rate falls. So the key is this easing is continual, it will be quite sure that the federal government will stop. So the Federal Reserve will stop raising its interest rate, and maybe very soon, if the economy shows signs of decline, the Federal Reserve may lower the interest rate. And also, like last time, I would like to share some trading trend in the Hong Kong market. As you could remember, the top performers in for the past 3 months is the telecom service sector. It's actually state-owned company, and most recently, all the Chinese name like state-owned company in all kind of business has been doing quite well, including the mining one, and including the oil and gas company, and all the state-owned company has get very great attention from the investor. And the reason is it could provide a very high stability and a very good dividend. Some example are the 941 China Mobile, and 857 the China PetroChina, and also recently I like the 1171 is Yanzhou coal mining. It's just a very good year of annual results, and this has 10 to 5 stock dividend, and a 12% dividend payout dividend rate. And also sometimes I think this the condition of the market is just swinging from a more conservative way. People investors just invest in SOE, and then all of a sudden it's just swing back to the more aggressive investment strategy, like buying the tech. So I would name quite 1-2 tech names that I think is good. Of course, Alibaba is one of the good one. It has been getting the market attention ever since 1 month ago. The founder has returned back to China, and then start showing some social attention to the public. And also, I think Baidu is a good pick because it has a leading AI ChatGPT investment. And also Bilibili, I think is another good name because its patent has intellectual patent has great potential in the future, and they are transforming it to movie and gaming. And gaming is a sector that has a good recovery in 2023 because since last quarter Q4 of 2020, the government has start releasing the rights to for those game developer to issue their new game. And also for the conservative play and mix of some new idea, utility with new energy concepts, it should time by time should be outperform the market. And the three of the top player is China Resources Power 836 and Nongyuan 916 and also Huanen 902. They are all have healthy dividend, and then they all have strong exposure in the new energy power output. And also the other more aggressive play is biotech with a good pipeline, like Akizo 9926. It has a very good product that's selling overseas. They just received $500 million US dollar deposit, and then potentially will have receive a 3-year contract of $5 billion US dollar for his AK 112 trucks export to the US. And also Innovate is another biotech company. It's a very good pipeline. These are quite volatile compared to the above name, the other sector. But when the time comes, when the market wants to get more exposure to the risk, and then and also when the government has released favorable policy, this sector usually move in the same direction among with others. And just like the beginning of the April, the sector is actually quite outperformed to the other sector. Is has most of the big name has a 20% increase since April. So this is my presentation. Thank you.
So right now it's time for our Q&A. Thank you so much, Johanne, for having that, giving us that insightful conversation with you. And we're just going to cover a few questions. But before we actually get to the questions, I have a question for you, Mr. Johanne.
Yeah.
I'm just wondering the dollar index. Earlier you showed the charts, and on my side, we've been looking at that chart as well. How low do you think it's going to go? What's your target price for the dollar index?
I think that 99 should be the 99 or 98. We won't drop too much unless there's a sign that the Federal Reserve wants to start lowering the interest rate. But at this moment, I think in this quarter, I don't think it will drop too low. Yeah.
Wonderful. Can you just stop sharing your screen for a moment? There we go. All right, perfect. I have a question from Fong Kian. Will the government or province debt in China, is that a potential risk for China's stock in recovery? The government or provincial debt?
You mean the Chinese government?
Yeah. Will that be a problem in the future?
I think it won't be, because the net export is actually doing quite well. And I think the problem of losing the foreign currency reserves has been eased. So I think the government has used some policy to buy time, and at least in for the central the central government should have enough power to control this. But maybe some rural provincial government, they may have some kind of problem, but I think it's still controllable, because the big picture is quite bright in showing the recent economic data.
Thank you, Johanne. A question from Siu Li Chua. For the banking stocks, what do you think of HSBC?
Well, I think HSBC has a very great challenge in the European exposures. I think ever since they start to issue the dividends now, the market may not expect they will have another great buyback program. So I don't think there will be a great support on the stock price. So if you compare the Chinese bank to HSBC, I think the Chinese bank right now is more favorable than to HSBC. Yeah.
Interesting. Thank you.
Yeah.
A question from Chong Comfort. Gold seems to be making a comeback. Do you foresee it's going to 2080 and breaking past the resistance to surge to a new high?
Well, that's a great question. I think the trend is there, and then this time the inflation is under control, starting under control. But you will see why. But you see the gold price keep going up. I think it's this more like anti interest rate play than inflationary play, because I think the market has trying to price in the Federal Reserve is going to lower the interest rate very soon, and that's why they think it's a good time to buy the gold at this moment, and then because the holding cost and also the attractiveness will be greater if the Federal Reserve really lower the interest rate in the future. Yeah.
So you're thinking physical or physical gold, or you're telling them to buy gold-related assets?
I think ETF would be a better choice. Yeah, because physical gold you actually need quite a lot of transaction costs and storage risk. Yeah, for me. Yeah.
Nice. Yuk Long has a question. What is your view on the EV sector in China?
Well, it's very interesting because from late last year, the sales has been collapsed quite a bit. I mean, the growth. The sales is still good, but the growth is slowing down. But for January and February and March, the sales figure is not quite good and quite disappointing. Right now, actually, in Shanghai, there is a huge exhibition for auto parts and also auto car maker. And so that's why this week you see some automaker rebound significantly. But I will stay away from this sector still because the competition is quite high and there's not very clear picture which company will be the winner. But one thing we need to when you pick a automaker right now, I think it is better to pick one that has a ability to export to the outside, because the domestic demand has been very strong, but I think the growth may not be there. The growth could be Chinese car maker gaining exposure into the overall foreign market. Yeah.
And speaking of winners and losers, CB Ng has a question. Between Alibaba and Tencent, which one do you think is the better bet?
I think Alibaba has more potential because they just announced there's 7 potential segment of their business they would like to materialize. It could be spin-off. It could be integrated with other company. But the signal is quite clear. It's no longer embedded with business that people could not evaluate. So I think later on this year or maybe next year, there will be more news from the company, and hopefully maybe they will start spinning off their business segment.
Interesting. And since you're there on the ground in Hong Kong, can you tell us a bit more about the sentiments behind Alibaba getting split into many pieces? What are people talking about over there?
Well, people just listen to those rumor, and then they start to they're trying to look into the financial the department of the company, the Ants group, and there's quite a rumor saying that they have been already contacted to the PB, the investment bank. They may preparing for IPO maybe later of this year or maybe next year. Yeah.
All right. And Liu CK has a question. Many banks are trading at low PBV and PE. For example, CITIC Bank, BCQ, Public Financial, Hong Kong. Any opinion from you?
Well, I think they all share very low PE, and people, but usually people use people to evaluate bank, to value the bank. But I think more importantly is the stability of the government, and also the ability to transform the excessive reserve to profit growth. So I would think Chinese Merchants Bank 3968 will be a better choice than the others. Yeah.
I have a question from Mr. Ko Soon Keng. He's wondering, what is the immediate downside for the Hang Seng Index?
Well, I think the index may retreat to 20,000, but I think 20,150 would be a great support in short run, given that there is not any negative headline news. Yeah, I think the market by itself is just like one day going up and the other day going down. So it's actually quite hard for investor to trade. But if you get patient enough, if you have strong faith on the equity market at this time versus like last year's, I think if you see it's dropped significantly for maybe a short period of time, this a good time to buy in.
Thank you. Rachel Yun is wondering, how do you view the split of business for Alibaba? Well, you answered that just now. And what is your outlook on crypto?
Well, crypto is it's actually quite hard because I think you should see crypto not as a big investment, but you could allocate some of your wealth to that, but may not be more than 5%, I think, because it still is a very volatile market, and ever since those Silicon Valley Bank they go bankrupt, another bank called Signature Bank also go bankrupt, and it's actually creates some fear, I think, because most of the clients of the Signature Bank is crypto-related depositor. So I think for Bitcoin or for cryptos, I think there's a huge platform risk. So it's very hard for people to accumulate the cryptocurrency, and then they store it into a platform, and then I think that's the other risk. Yeah. So besides crypto itself, there's a storage risk. Yeah, that's what I'm saying. Yeah.
I think that's a great insight because some people forget that products don't just stand alone and offer returns. There are also different risks associated with them, and some of the risks have a higher probability of happening and have already happened with other crypto assets and platforms. So I hear you, Mr. Johanne. Thank you.
Yeah.
Liu CK has a question. The dividend from HKSE, is it tax-free?
Well, yes, in Hong Kong, there's no dividend tax, yes. Except for some stock like the Prada, because it was based in Italy, and then the Italy government will withhold the tax for that. Yeah.
CP Ng's question is, tourism is back locally in Hong Kong and China as well. Which related companies should we look at in Hong Kong?
Sorry, I missed the first part of the question.
He's wondering, which related companies should we look at in Hong Kong in relation to tourism?
Okay. I think Links REITs is actually the good one because it just announced a right issue. It has been dropping significantly, and then it's operate malls in Hong Kong, and also invest a lot in China too. And if more people coming to Hong Kong from China, the population growing, I think it would be benefit to Links. It is not directly related to travelers, but as Hong Kong more people in Hong Kong going to shopping mall, I think it will benefit the ability to get a higher rent. Yeah.
Thank you. And D has a question. What's your view on JD.com compared to Alibaba?
Well, I think JD has more competition than Alibaba because it has the delivery parts of the company has a lot of the cost problem, I think, and the competition between Alibaba, Taobao, and JD, and also PDD, Pinduoduo, is actually makes JD in a very bad situation. So I will rather pick a more diversified company like Alibaba than JD. Yeah.
Wonderful. Tiang Kao Fu has a question. What is your view on Concord New Energy? Is it good for long-term investments?
Concord. I don't recall this name. This may be a mid-cap that I don't follow much.
Maybe Tiang Kao Fu. Maybe you can send over the stock code, or maybe you can ask us another question.
Yes.
All right.
Sorry about this.
No problem. Ray Wong is asking, China is investing 170 billion into Malaysia's automotive and oil and gas part. Part of this investment is channeled by Rongsheng. What's your investment outlook on this? Do you see retail investors? Should they give attention to oil and gas and automotive sectors in the long term?
Yeah, for oil and gas, I think the state-owned is a better pick because they actually, all the state-owned company has not written, but they promised high dividend payout. So like PetroChina and the Sinopec, I think is a very good pick right now because especially Sinopec has been underperformed for many years. And I have seen from the last reports, it has improving operation margin, and also is also pay out the dividend generously. So Sinopec is one under-owned stocks in the energy sector, and also PetroChina usually, of course, is the best pick also. Yeah, and automotive, as I just talked before, the NEV and as for what I've seen last few weeks in China, I've been heard that the domestic brand name has been hard hit. So most of the people, they just want to buy an NEV, the electric city car, because they are cheaper and then they look more cool. And so when you pick the automotive company, you need to be careful to not picking those with new energy car, but they have a huge sales relied on traditional brand. So I would say it's kind of hard to invest in automobile stocks in this year, I think.
I hear you. And I just want to dig a bit deeper into Ray Wong's question. So he's actually asking this in relation to the Malaysian Prime Minister going over to China and securing 170 billion ringgit, not US dollars, in investments for Malaysia. So what is the thought process or motivation, do you think, behind this effort by China to invest in foreign countries? What is their incentive, you think? Is it an exercise of China's soft power, like we always say? Or what do you think is their goal or motivation?
I think it's they are trying to attract investment back to China. And in a way, they invest in the other country, and then they create a two-side trading strategy. Just like since 2018, Chinese export to US has dropped a lot, but actually it has Chinese export to Vietnam has increased significantly, and at the same time, Vietnam export to other G7 country has doubled in 2 years. So I would say on the surface, it's like the Chinese losing the export, but it's actually going through from Vietnam. So in this case, I think the government want to create another business partner with Malaysia, and then has more security to export their products through Malaysia. So this could be the case. Yeah.
Nice. And our last two questions, we have one from Kong Chiu Kwok. Gold price is gradually rising. Yep, we noticed that as well. Why is that happening now? Is it due to US and China tensions, or is it due to the banking crisis? He just wants to know why.
I think it's connected to the banking crisis. It's less reasons on the inflation, because before, like the traditional wisdom said, when there's inflation, people buy gold, because this is one of the asset class that will inflate it. But this is not the case for the past 4 or 5 years. But it has been outperformed the many of the asset class this year. I think it's because the investor are anticipating a future rate decrease from the US. So they want to, and then they don't see US GDP is growing upward. So I think this is a stagflationary play. So that's mean the inflation is still there, and then economy is slowing down, and then there's no other choice but for the Federal Reserve to lower the interest rate. So people buy gold to benefit the ride in the future.
And finally, we have this question from Tan Gun. Speculative, Sense Time, 0020 is the stock code. Speculative stock, or do you see value at 277 Hong Kong dollars? Sense Time, 0020.
Yeah, this is, it has a rebound because of the AI concepts. But the big thing is the supply demand of the shareholders. Sadly, it has a group of shareholder has jumped into the stock at a very high price and during before the IPO, and the lockup period has gone, and then for any time they could sell their stock. So I think it's quite risky for investors to buy the stocks because you don't know what time one of the major fund will start selling. So if you want the AI player, maybe there's another choice. Yeah, better than Sense Time. Yeah.
All right. And I would want to let you go, Johanne, but we have 2 questions and people really want to pick your brain. Ray Wong is wondering, will we see another continuation of One Belt, One Road initiative in ASEAN countries based on President Xi's party policy?
Yeah, I think they are doing it. I have read articles. They talked about the One Belt, One Road again, and you could see the infrastructure sector. Very coincidentally, a state-owned company too. Has been doing quite well these days. So I think the government is pushing the foreign policy, and then I think this is happening again in the later half of the year too.
Oh, exciting time to be alive. Justin Hong is wondering, he wants you to look into your crystal ball like you did in 2020 and 2021, where you gave us excellent closing prices for Hang Seng, hit it right on the dot. Hang Seng Index, what price do you think it will close at this year?
Wow, this is very hard this time because I will explain the reason. Because if U.S. entering recession, like most of the investors anticipating right now, the interest rate is going down, which is good for Hong Kong market. But the recession itself may not may have a very negative impact on economy in China and Hong Kong too. So it depends on how fast the U.S. GDP growth slowing down, and that will greatly affect people investment decisions on emerging market. But I'm actually quite positive still for this year. I think if I need to pick one point, I think this year we still not see the peak yet. So I would say 22,500 would be a great guess by the end of this year. Yeah.
Nice. Just to jump over a few questions, we see a lot of questions, people asking about the Hang Seng range. Now, I know earlier you mentioned that in your first slides, but perhaps they missed it. VT is asking, number 1, what is the range of Hang Seng in the next 30 days? And Ka Kiat Chiang is asking, what's the immediate resistance of Hang Seng Index? Is it 21,000? So they want your 30-day range and whether 21,000 is the next resistance.
I think 21,000 is a very recent resistance. If for 3 or 4 weeks, maybe we could test 21,500 or around that range. And for the support, I think 20,150 is the most recent support. Yeah, but if it break through this level, it may signal of resume downtrend. So I would think we need to watch very closely at the 20,000 level. Yeah, but I'm quite positive for maybe the next weeks or so. Yeah.
Just a matter of time then. So Liu CK is wondering, HKBN and HKEI, is it a buy for these two?
HKBN?
Yeah, and HKEI.
HKEI is the index. Actually, HKEI is the index, right?
Yeah.
Yeah. So if you say the buy, then I think you were talking about buying the 2828 ETF, right? I think that that's a good choice. It's actually outperformed the Hang Seng Index, I think, because it has the most state-owned company inside that index. Yeah, and it actually fall between the tech index and Hang Seng Index. Yeah, so I think it's a good investment.
Nice spot there,
Yeah.
Liu CK. Liu CK is also wondering about HK Broadband Network 1310.
Oh, this one actually I don't cover that much, but people buy these stocks. Usually they they look at the dividend yield. So it's quite stable business. I myself is using their service, but I couldn't see the huge expense on their business side. So yeah, I couldn't comment too much on this. Yeah, sorry.
Understand. You know everything, but we don't expect you to know everything, you know? D has a question. In that case, for the question earlier about AI stocks, D is asking, what is your AI stock recommendation?
Well, there's quite a few names. I think 9888 is one of the biggest one. The Baidu. It not just has the AI developing division. It has also other business division that link to the corporate level. So if they have successfully satisfied the clients, the AI technology that they are trying to build recently will actually attract more business contract from their different from between different business divisions. So I think 988 is a good pick. Another one is actually people could not just invest in AI, but also take a look the infrastructure of those AI company. So Lenovo actually is doing quite well recently because they have people anticipating their products will be widely used to developing AI technology by the corporate clients. So this could be another AI play. Yeah.
Nice. And final question, Liu CK is wondering about your views on HKSE 2368.
2368.
HKSE.
Sorry, I don't cover this much.
Yes. 2368, Liu CK, do you mind telling us the full name of this stock? But if it's 2368 and Johanne doesn't cover it, then that's too bad for this round, Liu. Hong Kong Electric.
Hong Kong Electric? Oh, number 3. Well, this stock is quite disappointing. A few years ago, I have some clients holding it, like long-term holding. It was it has been distributing stock dividends for every year, so almost 20 years, and then they suddenly stopped paying it. I think it's last year. So unless they return to paying back the stock dividends again, I couldn't see the much attractiveness on this stocks because its business growth is not that good compared to the China's components. Yeah.
Understand. I was going to wrap you up, but just to entertain one of our final questions we have over here, Ray Wong, he has a random question. His company is a top Vietnam MNC focusing on software. He just wants to hear your advice if it's okay to invest in Vietnam market these days.
Well, it's just like another emerging market. This has a great opportunity, and I have read a lot of research on these of the country, but frankly, it's very hard to give advice because I don't understand which sector you want to invest and how would you invest, because you invest in the stock market or you invest as doing a business with the local partners. So yeah, it's very hard, but I could say the Vietnam, the country's GDP will continue to grow, and it has attract a lot of foreign investment recently, and I think the trend will continue. So yeah, I would say there should be great opportunities in this country, but yeah, but as usual, you need to be careful to how you invest, yeah, and what kind of method or asset class you invest in. Yeah.
Yeah, we always look at the assets as well as the structure that supports it as well, not just on its own, isn't it?
Yeah.
All right, just to wrap things up, Dorothy's asking the 3 best Hong Kong stocks that you would recommend. You gave us some recommendations earlier, but top 3.
At the moment, I think very short term, I think Ping An Insurance, they should be benefit from the recovering of the Chinese real estate market, and the Chinese bank, the Merchants Bank, China Merchants Bank, 3968. I think it's a good choice. And if you remember at my slide, I have some stocks that recommend, but those are sector rotation. That means some trading days, these are the outperformer, and then all of a sudden it lose the tension. So so each sector, I think, you need to pick a good pick. So I would pick another one is a biotech company called Akiso 9926, because it has a very great drug pipeline, and then they could already export their drugs to the foreign country. Yeah. So yeah, if you ask me for short term, I would say these 3 stocks. Yeah.
Wonderful. And that's all the time we have for today with Mr. Johanne. Thank you so much for letting us look into your brain for such a long time, Mr. Johanne. We really appreciate it. And we appreciate having somebody on the ground in Hong Kong telling us, and not just reading the news and not really understanding what's going on. Your insights is invaluable to us. Thank you so much, Johanne.
Thank you, Isabelle. Thank you, Kenanga. I enjoyed greatly. Yeah. Thank you.
Yeah, we really enjoy your sessions. And for those of you who actually want to chat with Mr. Johanne a bit more, maybe you can write your questions on the Kenanga Facebook, and we can maybe ask him those questions in the next round, where we'll have him again next month. It's always a pleasure to have you, Johanne. Thank you.
Thank you. See you guys soon.
Definitely. Earlier, remembered, we mentioned for those 100 ringgit Shopee vouchers, you just need to write your 3 top key takeaways on the link that we posted earlier. So that's the Kenanga Facebook page. If you just post your 3 key takeaways, we'll choose the top 10 of those, and each one will go back with a 100 ringgit Shopee voucher that you can use immediately. So right now, we're going to go into structured warrants, and we're going to start a bit more. It's a bit like I promised in our last last session last month. This session is going to be more for beginners. So if you've heard it before, I do apologize, but it's always good to hear stuff again. We have a lot of beginners that will be joining us. So if you don't mind, can you just type out, if you're a beginner who's watched our webinar for the first time, can you just press 1? If you've actually seen our webinars before, press 2. If you've watched it 3 times, press 3. If you've seen our video multiple times on YouTube, press 10. I don't know. So let me know how many of you have actually watched our webinars before. Because the thing about structured warrants is that they are just a tool. They are a weapon for you to use to attack the market. That's why we appreciate Mr. Johanne's session today. And Mr. Kevin Liu is going to be here on Thursday, 8 to 10 p.m. I know Bursa just announced that it's going to be a Raya break on Friday. The news just came out today. Thank you to our Prime Minister. So watch that webinar that's coming up on Thursday. So I see a lot of individuals posting Kim Eng 10, Jenny 3, Stefan 10. Wow, you guys. Feng Kian 2, Carmen, Samcor. All right, a lot of repeat views over there. For those who have actually watched this session before, I think you've already seen most of what we're going to cover because this is going to be a beginners. I'm going to cover a few things today, which is... So we're going to cover as much as I can in the next few minutes because we wanted to answer those questions from Johanne. So we're going to cover the big idea, this part. And hopefully we can cover some of the types of structured warrants as well. And then we can get to the Q&A. If you have any questions, just type them in the chat as we go along, all right? So let's get started. So structured warrants, they are really just a tool, a weapon for you to attack the market. And a lot of you ask, why must I even bother learning about warrants? Why can't I just buy the China stocks, the Hong Kong stocks that Johanne has mentioned? And the reason that the Hong Kong market has the largest structured warrants market in the world, they call it DWs over there, derivative warrants. Those are the ones that I was trading at before I joined Kenanga as a PDT. The reason that that market in Hong Kong is so large and largest in the world is because these stocks are very expensive. You will notice that a lot of the stocks that Mr. Johanne recommended earlier, they can be in the 100, 200, 300 Hong Kong dollar range. So that has forced the Hong Kong market and Hong Kong traders to look at a cheaper, lower absolute price. I wouldn't say cheaper because it depends on the amount of the quantity that you buy the units, but it's a lower entry point to enter into these stocks, if that makes sense. If that makes sense, just press yes, and I will know that you got it. So why should you even bother, right, listening to this next part on structured warrants? Because we always say that you need to be prepared. You need to know what tool or what weapon to use. So when the opportunity comes up, say the market does something like this and it just about starts to break up, you will actually have the opportunity. You'll spot it and you already know which weapon to use. So I always say success is preparation plus opportunity plus luck. And the more that you prepare, the easier it is to spot opportunities and the luckier you get. So you get a higher chance of success. And for beginners out there, the question to always ask whenever you listen to this webinar. So you've heard Mr. Johanne's session and it might overwhelm you. You know, you're thinking, oh my gosh, he's given so many stocks, so many picks. What is sector rotation all about? How will I be able to spot it? I only want to invest in this particular few stocks. For example, he mentioned a bit of banking, a bit of different sectors, real estate. Where do I actually fit this all in? So the question to ask yourself is always, so what? How does this news, how does this webinar, how does this information affect my financial goals or my portfolio? For example, we had a question from somebody that asked about Vietnam. Do you really want to go and become a Vietnam specialist now? Not necessarily, right? Because you're asking, will that news affect you? For example, SVB Bank. Did that piece of news that was supposed to be so catastrophic for the American banking system, does that affect your little portfolio in Malaysia or in Hong Kong? Or how does it affect it if it does? Second question to always ask yourself is, how do they make money? Bankers, fund managers, insurance agents, all the stock market gurus that you see all over the place, right? Now, I know Mr. Johanne isn't the rah, 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 buy this immediately now, I promise you, you'll make a ton of money. He isn't that sort. He's very factual and analytical. And honestly, he does these talks for us for free. So the question to always ask is, how do they make money? The person selling me this product. Finally, what's your magic number? We'll actually get to that in the next session anyway. So some fun concepts to read about. I'm not a financial planner for you, but over the years, if I could talk to my 21-year-old Isabelle, I would tell her to read up on this handful of these personal finance concepts and life concepts, which I think are really interesting. So if you're somebody that's young in your house, ask them to go through these concepts. The Ikigai concept, the Wheel of Life, 6 Jars Money Management System by T. Harv Eker. You've got the Cash Flow Quadrant concept on buying assets before buying liabilities by Robert Kiyosaki over here. Cone of Learning, which is the reason why I'm giving you guys the 3 key takeaways to do, right? So the Cone of Learning, it always says that we learn. I grew up partially in the Malaysian education system. I started in an international school, and then I got transferred to a local school when I was younger. And I realized that the difference is local schools, they focus a lot on reading. And you notice that after 2 weeks, we only tend to remember 10% of what we read. If you hear the words, look at pictures, watch a movie, that is still under passive. Exhibits, demonstrations, see it done, that's still passive. In order to make everything stick, for example, whatever you've learned, you got to move your learning into the active category. For example, participating in discussions, like many of you asked questions, you participated. Giving talks, doing a dramatic presentation, maybe you can explain to yourself what you've learned today. And I'm actually forcing you to be more active in your learning by making you write your 3 key takeaways and posting them on our Facebook. So that's actually more for, I could easily do a lucky draw, right? But that's more for you guys to filter through what you've learned today so that you can remember it in the future. And when I ask you what you've learned in 1 month, you would actually remember. And finally, doing the real thing. So over the weekend, so we'll take a short conversation, all right? Over the weekend, I was at TAR UMT. It's a university over there in Genting Klang in KL. We had the Malaysia Youth Trading Championship, the MYTC 2023. And 772 of these students actually joined this competition. It's an online trading competition. And what we've realized is that there are 3 ways to learn trading. First way, the bestest way, of course, is to trade in real life. You can put a small capital, maybe even 1,000 ringgit, and that will teach you more than reading any book will ever teach you, more than listening to any webinar. Second best way is to actually join these gamified trading platforms where you trade, they give you 100,000 ringgit, right? And when you make something like 20%, that's 20,000, you think you're fantastic. But the problem with gamified trading platforms is that they are a simulated environment, meaning there are rules that don't apply in the real world. For example, a trading game can say, oh, you need to trade 5 different stocks. You can't just focus on one. In the real world, you can be trading that one single stock that you know so well, for example, the Hang Seng Index, and you trade it every single day and every single year because it's so volatile, and that's the one baby that you only have to look at. Or maybe you're exceptionally good at looking at Top Glove, and every time it pings from 102 to 108 to 102 to 108, you know the behavior so well, like it is your child. All right, you know how your girlfriend or boyfriend reacts. That is your baby, right? And the third way, which is not so effective but useful, is to do paper trading. So if you actually want to start trading, those are the 3 ways. Number 1, real trades. And number 2, gamified. And number 3, paper trade. Okay? So Kok Chu Kwok says, call warrants very difficult to make good money unless the mother share spikes up, like what happens to the glove companies in early 2020. I agree. It is very difficult to make money in call warrants when the underlying do not have any activity. Call warrants are a bullish product. I'll cover different products for different markets in my latest slide to answer your question. But why do I focus so much on understanding how call warrants work? I always say it's like a barbell strategy, right? You need to have different portions of your portfolio for different products. Like even Johanne mentioned earlier, you can have a portion for ETFs, portion for stocks, portion for crypto even. So right now we are diving deeper down into the call warrants a bit. And the reason we actually look at call warrants in so much detail is because it actually offers, it actually is a kicker to your portfolio. I'm not asking you to put 100% of your portfolio in. The reason is because these structured warrants, they offer some really crazy returns that make this calculation possible. So earlier I mentioned, what is your magic number? And if there's one homework that I want you to do tonight, is to actually go online, check out a calculator that offers you compounding returns. So for example, this is a concept that I want to share with you. If you actually have, say, 10,000 ringgit, and annually you make a 30% per annum, and every single month during that year, in January you put in 1,000, February you put in 1,000, so on and so forth. By the end of that year, by the end of 12 years, you'll be making 1.2 mil. Attractive. However, if you have 20% per annum, you'll only be making 615, and if it's 10% per annum, you're only having 301. Just remember that if you start with 10,000 ringgit and every single month you put in 1,000, 1,000, 1,000 in, the total number actually is only 144,000. So it's either if you actually just put that money into, I don't know, under your mattress or in a Milo tin, that'll be 144,000 versus something like 1.2. So that is the reason people are interested in things like structured warrants or riskier products. But for a lot of these products, it's just a matter of understanding them, understanding the risks tied to them. So let's say you've got somebody young in your house, a 20-something-year-old, or somebody comes up to you and they're wondering, I actually am thinking of saving all my money until I reach 100,000 ringgit first. And then only I'll start thinking about investing, right? I want to create a nest egg first, and then I'll use that money to do something. The issue with that is that if you're not looking at ROI, so this one is 100,000, and it's only paying you 10%, whatever product you're trading, 10% per year, okay? 10% ROI. You follow the same thing, even with 100,000, after 12 years, it is only 584,000 ringgit. As compared to, let's say, somebody who started with 50,000 at 10%, compounded returns, that's about 427. So it's roughly the same. You see how if you spend an additional few years growing your 50,000 to 100,000, there is not much of a tangible difference in terms of the end number over here. So the main thing to remember is you want to focus on actually getting the most ROI within a safe range, something that you understand doing. So that's why the ROI number is so important, more than your starting point or your principal amount. So even if it's 10,000 ringgit, focus on how you can grow that 10,000 ringgit and get 30% per annum. If you're exceptionally good, 30% every 6 months. And I'll show you for our traders' ROI. These are trades on the Hang Seng Index. So we had a Garmin campaign last year where we asked traders to share the screenshot of their profitable trades, and they would win Garmin watches. So just to show you a really quick one, from 2nd of August till the 3rd and 4th, This trader bought HSICJD over there. And on this trade, CJD, he made 25% return, and on CJX made 23%. So that was in a very short time, as you can tell. That's how Hang Seng Index works. He bought it, the first one, on the 2nd of August, and the next one he sold on the 4th. See, these are just intraday trades, and that is giving you these kind of returns. For example, another one would be, I'll zoom in closer so you can have a look. Something like this, 10th sold on 12th, 12th, 9th, and 12th. And that's giving him 28%, 7% returns. So it is very possible to be making these kind of returns if you're trading Hang Seng Index warrants. Like I said earlier, we care about the return, right? ROI is more important than your starting capital. If you can keep it up, all you need is 10,000 ringgit to grow. And even if you don't compound it, the returns are going to be significantly higher than you just investing in something like a fixed deposit. In fact, fixed deposit isn't even investing, if you ask me. That is really just trying to match inflation. Sometimes fixed deposit doesn't even outpace inflation. So different products, just like Kong Chiu Kwok said earlier, structured warrants actually fit into these different asset classes, right? You've got stuff like bonds, ETFs, shares, options, and structured warrants and mutual funds. And each one of them is like a season. When you're in a summer season, you are wearing, I don't know, light shirts and maybe linen pants. If you're going to spring, you're wearing something different from spring to summer. In autumn, you're putting on maybe a cute Uniqlo jacket. And in winter, you're wearing a winter jacket. So each of these products are for a different time. Not just different time horizon to trade, but also a different season in the market. For example, let's look at something like ETFs. They are diversified, they give you access to index performance, and they have low management fees. And you compare that with something like bonds. They give you predictable returns, better interest rate than savings accounts, and it's a fixed income. But for structured warrants, it's the season, right? The season when stocks are actually rallying and doing something bullish. Then only would you use structured warrants. For example, you can trade the company shares at a fraction of the price. They have a leverage effect. They're a hedging tool. They're a top riser in bull markets. And the maximum loss is capped at your investment principal. You won't lose more than you invest, unlike some other products. So like what I wrote over here, if you're bullish, then call warrants. If you're bearish, then put warrants. If you're unsure, avoid. Easy as that. Which issuer actually tells you to avoid when the market isn't right? Only Isabelle is so honest. So barbell strategy. Earlier, we mentioned having a portfolio of things, right? A few things in your basket. So for example, if your capital exposure, I'm giving you just a rough example. Let's say you start with 100,000, right? I'm just choosing a nice round number. And each of them, you have a different percentage in there. So that means fixed deposits, 50,000, nice and safe, giving you 3%. ETFs, for example, 30%, giving you 8% per year. And if you trade Hang Seng Index, you just put in perhaps a small amount and that gives you 50. So instead of just having these two products, let's say only a fixed deposit and ETF, I actually calculated if you actually just have those two products in your portfolio, it's only going to give you a 4.9% return per year because of the proportion, right? However, if you have something like a Hang Seng Index warrants or a Malaysian equity index or a China equity index, it actually kicks up your portfolio and it gives you a higher average return per year. You can see the calculation over there when I send over my slides. So this lovely quote that I like is by Charlie Munger. And he always says, Spend each day trying to be a little wiser than you were when you woke up. I know a lot of us, we're getting a bit demotivated because interest rates are getting so high and everything is so expensive these days. But this is more of the Kaizen principle, if you heard it. Anybody, one of you heard of the Kaizen principle? I'm sure many of you have heard of it. It's a Japanese principle. If you can tell me what it means in the chats, I'll be very happy. No? Nobody? All right. Well, Kaizen principle, it's about continuous improvement. It says that even a small amount, an incremental amount each day actually it adds up. So, for example, it's called continuous improvements. You don't just improve once a year when you attend a webinar. You improve every single day incrementally. For example, even 0.5% of an improvement a day in your knowledge adds up because habits, they force perseverance. Perseverance become your character, and that's about it. All right, so let's get to this next part. Structured warrants, the types of structured warrants we can cover. So until today, I've covered this quite a few times, but I'm very surprised to see this pop up in our Telegram chat. The difference between company warrants and structured warrants. So I'll just cover it today for those beginners out there. So structured warrants, you can see over here. The naming convention is quite different. They are CCC for call warrants, which means when the underlying increases in price, the call warrant increases, it exaggerates the price. It goes like that. Same thing for indices as well. They have CCCs in them. And for put warrants, they are put warrant H's. So let's say the underlying goes down so much, the put warrant actually goes up significantly. And the reason is it allows you to take advantage of a bearish market. Say, for example, if you think Harta is going to go downwards, then you would try put your money into a put warrant. Top Glove is going down, you benefit by a put warrant. Same thing as well for the indices. And the naming convention for company warrants, they have W's. So it's Excel Force WA, M3 Tech WA, or WB. So that's the difference between the structured warrants and their names, an easy way to notice it. And the purpose of these warrants, they are quite different. So they are used for different things. The easiest way to remember it is that these structured warrants over here, they're issued by third-party financial entities. So right now we've got 7 issuers in the market. Bank, Maybank, CIB, RB, Macquarie, and Affin Hwang, who's now joined the structured warrants issuer market. So company warrants, they are actually issued by the company themselves. That means Exaforce themselves, M3 Tech, Sanichi, they issued it themselves. It wasn't by another third-party financial institution. Next, you need to remember that for these products, they are an investment or trading tool, structured warrants, which means they will be cash settled at the end. You will not be getting the stocks of Harta, HA, or Top Glove HB if it expires in the money. You get a cash settlement and that'll be deposited into your account. Not the old way of company warrants where you actually exchange them for the stocks, the physical settlement, we call it. And finally, and of course, it is a capital raising tool for the company. Remember, I always asked, I reminded you earlier, always ask why are they doing this, right? So structured warrants, why are they created? They're created to be an investment or trading tool for you. It's a weapon for you to trade, not to hold until expiry. A company warrant, on the other hand, the reason it's made is because the company wants to raise money. It is a capital raising tool for the company. And finally, that means that the trading strategy is very different because of the existence of a market maker for structured warrants and no market maker for company warrants. So company warrants, they can actually limit up even if the actual stock doesn't even move very much because it is traded is separated, is detachable. Which means the trading strategy for these two are very different. For structured warrants, you would consider a musty strategy, which we always cover. You musty guna the musty strategy and use the live matrix. And for company warrants, you can consider many strategies like using premium, discount, expiry, and volume to trade those. Now, the advantages and risks. There's no such thing as a free lunch, right? There's always the pros and cons. In life, we always know that if you are a very kind person, there is a chance that you'll be taken advantage of, right? There's always a dichotomy. There's always a push and pull in life. So there are advantages for structured warrants, and there are also disadvantages which you can use these different tools to correct yourself. The musty strategy can help you minimize those risks. So of course, you can read up more about this later on. The advantages are the gearing effect. Like I showed you, if the underlying goes up a bit, the call warrant exaggerates a lot. Limited loss, profit from bull markets or bear markets, no margin call, lower capital outlay, release your share capital. So this release share capital idea is that some individuals, for example, let's say they were looking at Top Glove, right? And they bought it at 70 cents last month and they rode it all the way to 1 ringgit and they bought the stock and they actually want to release the capital. Sometimes they might even take profits, say for example at 1 ringgit, and they might transfer a proportion of that into a structured warrant while releasing the cash, while cashing out. So that's how you release share capital using structured warrants. And the ease of trade, because it's a listed derivative, means that you can buy it on using a normal CDS account. The risks, of course, include time decay risks. Structured warrants have this unique feature because they have an expiry date. So you are always fighting against time decay, which is why you would avoid a warrant in its final month. Same thing as expiry considerations. Whenever a warrant expires in the money, at the money, or out of the money, if it expires in the money, you can actually get the cash settlement check. But if you sell it before it expires, that's fine as well. And you should do that for out-of-the-money warrants. For example, out-of-the-money warrants could have easily gone from 1 cent to 10 cents. And if you don't actually exit at 10 cents, then on expiry, if it's out of the money, meaning if it's below the exercise price, you'll actually end up with a big fat zero. You actually get no cash settlement. Gearing risks, market risks. You can see over there, it's a double-edged sword. Market risk is a systemic risk. Liquidity risks, they are there as well, but with the presence of a market maker, you can actually reduce these risks. For example, if there's a bid and offer price, the market maker is obligated to offer a significant quantity over there for people to enter and exit. So liquidity risk is a lot lesser when it comes to structured warrants because of the presence of a market maker compared to stocks. In stocks, you can see sometimes for not very liquid stocks, they can have a 5 cent, 10 cent spread, right, between the bid and the ask. The warrants will usually follow that only if the stock behaves like that because they are automated. They will follow, right? The derivative of the stock. But when the bid and offer is tight, the warrant will do that because of the presence of a market maker. And the issuer default risk, volatility risk is there as well. Issuer default risk, fairly low because all of these 7 issuers are already there. You already know these names that I mentioned earlier. There's the risk of extraordinary price movements, true, but that's the same thing with stocks as well. There's always extraordinary price movements. And Forex risk exists for our Hong Kong, mainly for our HSI index warrants and for any other product that is listed on a different index. Then you have Forex risk. But the main thing when it comes to combating these risks, I realize, is just to remember musty. So the main risks that you can avoid just by remembering MESTI, is that M, matrix. M stands for matrix. If the issuer has no live matrix, or you forgot to look at the gray and white zones, or you never noticed the traffic white colors, then that is a risk, because for the Kenanga Naga Warrants live matrix, it actually shows green, yellow, and red. So green means the bid and ask is tight. Amber or orange means that there is a slight spread. We increase the ask, we maintain the bid price because maybe inventory is running out or expiry is coming soon. And if it's red, it means do not buy this warrants because maybe the issuer is totally out of inventory or doesn't want to sell for any reason. But you can always exit by selling to the bid price at any time anyway. It's just don't enter, but you can exit. And you also want to remember to balance high effective gearing with few tick sensitivity. I'll cover more of this later on. Time value decay, avoid the final month, and I is for issuer. You need to ask the issuer loads of questions. So just to wrap things up tonight, I know it's a beginner session. On Thursday, we'll cover a bit more of the warrant specifics, but I want to get these key things out of the way first. So the common mistakes that traders always experience. In the past, I've been an issuer for structured warrants since 2016. So that's about 7 years. So 7 years, the mistakes are always the same. I don't understand why. Okay, I do understand why. It's because people don't really analyze their behavior. So the main mistake that we see is that people don't actually limit their risk. So if you watch CNBC or Bloomberg, like I do every single day, you'll see these news. Stocks plummeted today to a near record low because that's what stocks do sometimes. There will always be catastrophes around the world. There will always be stocks falling to where you never imagined they would. But the idea is that you need to set a stop loss using the live matrix. At that time, you might not understand why the stock is crashing in that way or behaving in that way. But as long as you have a good stop loss, it will prevent you from having additional heartache and wondering why, when the company only announces why 1 year later, or okay, not 1 year, maybe 1 week later when the stock has actually dropped already 50%. I'm not taking profit and paper profits. So the main idea is that I see a lot of screenshots that people send over and they share that as their pride and joy. Unfortunately, a lot of times they never actually exit at that price. So remember, set a target price, behave like a robot. It hits your target price. You can have a strategy where you exit 50% and you let the other 50% ride, or you have a climbing stop loss or climbing take profit, a 1 bar stop loss if the stock is climbing. So remember to always take profit and exit a position. You need to close a position. Don't just let this run and then you have a position on stock A and then it's making money, then you faster jump into stock B and then you add a position stock C and you add position stock D, and by the time you're looking at stock D, you would have forgotten what stock A is doing and your profit would have vanished. Just like water down the drain. Thirdly, employing a buy and hold strategy, that is very useful for stocks, not so good for structured warrants. For example, you can't hold a structured warrants these days for a year. That is ridiculous because structured warrants have an expiry date. And it's good to remember to avoid the final month before an expiry date. The second you buy a structured warrant, key in onto your phone's calendar the expiry date. I can't tell you how many people have forgotten. And only at the last trading dates when the structured warrant is suspended, they call me up on my hotline and they beg asking to reopen the warrants as if I can do that. It is a listed derivative on Bursa. You can't just open it up and let you exit the position. Unfortunately, if it's last trading day, it is last trading day, guys. Okay, so buy and hold strategy, maybe you want to pass on your public bank stocks to your great-great-great-grandkids by putting it in a trust. Good for you, but you can't do that with structured warrants. Another few mistakes is refusing to cut loss. For example, stocks remember the purpose of it. So stocks and ETFs, they are for investing, and warrants are for trading. So it is long-term. Oh, where's my bracket here? These are for long-term investments, and warrants are for trading short-term. Remember the barbell strategy. And of course, avoid averaging down. So sometimes you can only see a person's behavior on paper, but you don't really know their mindset, what they are thinking when they do things. So some individuals, they engage in dollar cost averaging, right? Which is you buy, say, 1,000 every single month in an ETF. And whenever an ETF is at a high point, with that 1,000 ringgit, you're actually buying less, fewer quantities. So dollar cost averaging is not buying the same 600 shares every single month. The idea is that if it's at a high price, you're actually buying fewer shares. When it's at a lower price, you're buying more shares. So that's the DCA concept, the dollar cost averaging concept. And some people, they try to apply that concept into structured warrants and average down, they call it all kinds of things. I would say you should just avoid averaging down. The reason being, if you've actually bought a position, say position A, you've actually entered the market. And when you realize that you're actually making a mistake, you should actually cut loss, stop loss, and re-enter, because a stock can actually, or warrant, a stock really, can fall a few times once you get it wrong, right? And when your price is pegged to say 1 ringgit, you're mentally clipped onto 1 ringgit. The second it drops to 90 cents, you're like, oh, buy. What if it drops to 80? Are you going to buy again? What if it drops to 70? Are you going to buy again? But if, say, the stock was 1 ringgit and it dropped to 90 cents and your cut loss was, say, 95 cents, you can actually take a breather and say, hey, hold up. Let me re-strategize. Let me re-look at the charts and draw my beautiful lines on the chart, and then re-enter at a more sane price. And say if you spot something like a double bottom or a triple bottom at 70 cents, then you know, now is the time to enter. So just pull yourself out, grab yourself by the shirt and say, get out of the market. This is not the time for me if you get it wrong. Don't do something crazy like average down. It is not stocks where you can just average down, and hopefully one day it goes up. Because it might go up, true, in a few years, but by then your warrant would have expired and your money would have been totally burnt, right? So different product for different timing. And finally, not using the mercy strategy, which we'll be covering, I reckon, on Thursday, since we're running out of time. So just to wrap things up, our frequently asked questions, I've compiled this list over the last 7 years, and I've actually managed to answer all of these questions in our webinars online, our beginners and advanced videos. As you can see, we have a beginners 1 hour and advanced 1 hour session on YouTube. And I actually write the short answers here in pink. So I've covered the basics, strategies, HSI warrants, live matrix tools, issuers, expiry, and corporate adjustments. And the short answers in pink, meaning I didn't really do a video on them because they're just a one-liner. For example, can I perform technical analysis on structured warrant charts? No, you can only perform TA on an underlying chart. Is warrant trading of Sharia-compliant stocks also Sharia-compliant? No, it is not. So, of course, I didn't do a video on it. That's a 10-second answer. 3-second answer. Next one. Why is there a live matrix? What is it for? 3 reasons. Number 1, to show the flipping points. It's a price chart, price table. So it's an indicative price table. You can read the terms and conditions over there. Second is to show the gray and white zones. Third is to show the traffic light. Why has the issuer opened up a spread? Because of low inventory or expiring soon. What do I do if I bought a warrant when it's green and now it's amber or red? No problem. What do I really do if I really want to buy a red and an amber or red warrant? Avoid buying it, but if you want to exit, there is no problem. And things like, if I win, won't the issuer lose? No, because of hedging. Issuers hedge our positions. We are on the same side. So that means if you buy a structured warrant, the issuer will hedge the position, a certain percentage. We don't hedge the whole thing. And we actually, as it continues to go up, we continue to hedge more. So we are on the same side of the trade, as you realize. And finally, what happens to my warrant when there's a normal dividend? Issuer has already priced it in. Mainly, all of these questions we've already answered on our YouTube at Kenanga group. So I do recommend you having a look at those videos that we have over there. And that wraps it up for today's session. If you have any questions, post them in the chat now. But I just want to remind you, as you type out any questions you might have, or you can keep your questions for Thursday, we do have that giveaway for the 100 ringgit Shopee vouchers. So remember, we have the link in the chat over there. We will share. Pang Pang is asking how to obtain the recording. The video is a bit blur. We'll be posting this video on our YouTube channel that we mentioned earlier. It's Kenanga channel, Kenanga channel, I believe. And you can watch the video recording either Wednesday or Thursday, guys, right? Wednesday, Thursday-ish. You can watch the video over there, Pang Pang, and you can see all of our other webinars up there as well. Because I know some people, I always recommend to watch on your desktop or laptop. A lot of people are watching on their little phones, like this. So remember, follow the Kenanga Group Facebook, press share, and write your 3 key takeaways from today's webinar. It can be 3 from my session, 3 from Mr. Johan's session, or 3 each. I don't really mind. So we can give away those 100 ringgit Shopee vouchers, and we'll be giving away another 10 vouchers on this Thursday as well when we speak to Mr. Kevin. He'll be on Thursday, 8 to 10 p.m. Same time, same place. I look forward to seeing you guys over there since we have no questions tonight. No questions, right? Let me just triple check. Dorothy, like I mentioned earlier, will have it up on Wednesday or Thursday on the Kenanga YouTube. So you just go to your YouTube app and search for Kenanga and Kenanga channel, and then you'll see the official Kenanga Investment Bank YouTube channel. Over there, we'll be posting Mr. Johan's session, and we'll be sharing the slides as well on our Telegram channel over here. Telegram channel, Naga Warrants. All right. So I look forward to seeing all of you guys very soon on Thursday. And if we have no more questions, we're going to wrap things up. Thank you very much for staying until the end. I appreciate it. And I hope it had a somewhat knowledgeable time for most of you, even if it's a lot of information to process. That's how it is. When it comes to, like I said earlier in my introduction, life is already hard, but life is even harder if you are stupid or if you do not do your homework. So a bit of homework now during this quiet period will increase your probability of success when the market does decide to rally and take action. And that can change in 1 night or 2 nights, right? So that's it for me. Thank you very much. Thank you, Kong Chiu Kwok. Thank you very much, Sam Kaur. Thank you, Dorothy. Night, guys.